Every Tuesday, in a room you will never see, a handful of people decide what your mortgage costs. Not the Federal Reserve, not your bank, not a politician standing at a podium pretending to be in control. A spreadsheet, specifically, an auction, dull name, dull paperwork, numbers, deadlines, a clock, no drama, no cameras, no headline, and yet this is where the price of money on planet Earth actually gets decided. Most people think interest rates come from the Federal Reserve. That's the story we're told. And it's not exactly wrong, it's just incomplete in a way that matters. The Fed sets one rate, a short-term one, a signal, but the rate that actually prices your mortgage, your car loan, your government's ability to fund itself, that comes from somewhere else. It comes from an auction, a weekly, sometimes daily, ritual where the US government sells pieces of paper called Treasury bonds, and the entire planet's investors show up to bid on them. Whoever buys that debt sets the price of borrowing for everyone downstream. Stay with that for a second, because it's stranger than it sounds. Here's why this matters right now, not as a historical curiosity, but as something happening this year. The United States has roughly $36 trillion in outstanding debt. That number is so large it stops meaning anything. So let's shrink it. Imagine a household earning $80,000 a year, in credit card and loan balances of nearly $300,000. That's the ratio we're talking about, not catastrophic on its own. But every year, that household has to go back to the people it owes money to and ask them to lend it more just to keep functioning. That's the auction every week, and every week somebody has to show up and buy it. For decades, the buyers were reliable, foreign governments mostly, Japan, China, oil-rich nations recycling their dollars back into American debt because it was the safest parking spot on Earth. That assumption is now cracking, quietly, without a headline event you'd remember. China has been steadily reducing its holdings for years. Not dumping, just drifting away, auction by auction, like a guest leaving a party early without saying goodbye. So who's filling the gap? Increasingly, domestic buyers, pension funds, insurance companies, and when those aren't enough, the auction has to get the attention of buyers who are pickier, buyers who ask harder questions, buyers who demand a higher price to take the risk. That price is the interest rate. This is the mechanism nobody explains well, so let's actually break it down. Here's how a bond auction works. Stripped down to the studs. The government says, we need to borrow, let's say, $50 billion this week. Investors submit bids, essentially saying, I'll lend you this money, but I want this rate of return in exchange. If demand is strong, lots of bidders, lots of competition, the government can borrow cheaply. Low rate. Confidence intact. If demand is weak, fewer bidders, or bidders demanding more in return, the rate has to rise to attract enough buyers. The auction still clears. The government still gets its money. But it costs more. And here's the part that should unsettle you a little. That rate doesn't stay in the room. It echoes outward. Mortgage rates are priced off the 10-year version of this auction. Corporate borrowing costs are priced off it. Car loans, student loans, the rate your local city pays to build a new bridge, all of it traces back, link by link, to how one Tuesday auction went. If the auction goes badly, if bidders show up unimpressed, demanding more yield, borrowing costs rise across the entire economy within days, not because a politician made a speech, because a spreadsheet full of strangers decided the price of trust had gone up. There's a term for a weak auction, a tail. Demand falls short of expectations, and the rate has to tail higher to clear. It sounds almost cute. It is not cute. A bad tail can move markets globally before lunch. Now here's the uncomfortable math, the part most explainers skip because it's awkward to say out loud. The US doesn't just borrow to fund new spending. It borrows to pay interest on what it already owes. Interest payments on the national debt have now crossed roughly $1 trillion a year. That figure recently overtook the entire US defense budget. Not because defense spending shrank, but because the interest bill kept climbing. Read that again slowly. The cost of servicing debt now outpaces the cost of the military. This creates something economists call a debt spiral, though they tend to say it gently, almost apologetically, because saying it bluntly tends to spook the very buyers the government needs at the next auction. Here's the spiral in plain terms. More debt requires more interest. More interest requires more borrowing to cover it. More borrowing requires bigger auctions. Bigger auctions require more buyers willing to show up. And if buyers start hesitating, rates rise to compensate. Rising rates increase the interest bill, which increases the borrowing, which requires even bigger auctions. It's not a wall you hit. It's a treadmill that quietly speeds up. And the irony, the part that should make you tilt your head, is that the U.S. government is, in effect, an addict who has to keep borrowing more, partly just to pay the interest on what it already borrowed. The auction isn't optional. There is no version of next Tuesday where the government simply decides not to show up. So let's talk about hype versus reality, because the public conversation around this gets the framing almost backwards. The hype version says, "Don't worry. The U.S. dollar is the global reserve currency. Demand for U.S. debt is infinite. This has always worked. It will always work." The reality is quieter and less comforting. Demand isn't infinite. It's conditional. Investors don't buy U.S. debt because they trust the government's spending habits. They buy it because, relative to every other option on Earth, it's still the least bad choice. That's not strength. That's survivorship. And survivorship can erode slowly, auction by auction, long before anyone rings an alarm. Confidence in a currency, in a government's debt, doesn't usually collapse in a single dramatic moment. It leaks. A weak auction here, a downgraded credit rating there, a foreign buyer quietly trimming exposure, citing nothing in particular. By the time it becomes a headline, the leak has usually been happening for years. There's a dark joke buried in here, if you want to find it. The most powerful financial mechanism on Earth, the one that prices your mortgage, your government's borrowing, the global cost of money itself,